Our next guest is going to give us his insights on the economy, the Fed's rate path, and so much more. Joining us at the table, PIMCO's global economic advisor, Richard Clarida. He's former Fed vice chairman. Good morning to you. Normally I'd say, what do you think of the data? But we don't really have data, or maybe we do. What data are you looking at right now, actually?
You know, you get things like ADP on the labor market. There's something up in Boston that scrapes prices from Amazon. So you're getting some numbers, but it's obviously not the gold standard, which is the government data, which I assume we're going to start getting pretty soon.
So what do you think is actually happening here under the covers?
I think the labor market's been slowing all year. The challenge for Powell and the committee is it slowing because of demand for labor, or is it slowing because of supply of labor, immigration enforcement?
And what do you think the answer is?
Well, I think as of September, they've judged that it's really sort of a demand story, which is why they cut rates in September, at least on a risk management consideration. And I think there's some evidence there, Andrew. You've seen some slowdown, for example, in wage inflation. But it's a murky picture at best.
You know, we just had Lisa Su sitting at the table where you are, and AI is a big question mark about employment. Do you think that's having any measurable impact yet?
Anecdotally, it does appear. In particular, you see, for example, employment for entry-level coders is way down. I do think it's too soon to tell, but probably we're moving in that direction. The question is, you know, the pace that we see and what sectors are impacted. Okay,
so we have the employment picture on one side of the aisle. We have the inflation picture on the other side of the aisle.
Yeah.
You know, if you were to talk to Scott Besson, he would say, look, inflation is decelerating, and it is. But there are pockets within the economy where you have inflation increasing.
Yeah.
And so if you were sitting back in your old seat, what do you tell Jay Powell about that?
Well, inflation, I think, is basically treading water. If you look at the Fed's preferred measure, it's running at around 2.8 or 2.9, and that's where it was 2 years ago. I think the Fed could make a case that but for the tariffs, it would be lower. But inflation's not falling, and it's been above target now going on 6 years. And so the point I'd be making that I'm making now is there's a risk to the labor market. There's also a risk that inflation is too high, and it may take a while to get it down.
But this puts you in a stuck position because, you know, if you're going to lower interest rates, you're going to make the inflation picture worse.
Yeah.
Maybe make the employment picture better.
Yeah.
And if you raise interest rates, you're going to do the opposite.
That's right.
It's the blunt instrument. So what do you do?
Well, I think it's a judgment call, and I think that's why the committee now is pretty divided. And as the chair said at the last press conference, people of goodwill can look at the data and reach different conclusions. But I will say that there is risk management on both sides of the mandate now, just not on the labor market.
Okay. When you put your PIMCO hat on and people look at either treasuries right now, by the way, think about equities. Where do you think we are in this cycle, if it's a cycle at all anymore?
Well, obviously, there's a lot of optimism about AI, but more broadly, earnings season, at least based on what I heard on this show and others, earnings season was pretty good across the board. And I think markets have formed a judgment. The Fed is cutting. I think the Fed can cut more if the economy slows. And there's a lot to like about the U.S. economy. Certainly, if you compare the productivity story, even outside of AI to the rest of the world, it's quite favorable.
Rich, when you were at the Fed, did you consider how the market was reacting before you would decide to cut or raise rates? Because if you look at the stock market right now, there's not much of a reason to cut, but this is a bifurcated economy, the haves and the have-nots.
And Becky, part of what's tricky about it, of course, is that markets are forward-looking, and so markets, to some extent, build in what they think the Fed is going to do. So there's an element of that. You know, Ben Bernanke once called it the Hall of Mirrors problem. But yes, as an official, I tried to look through that reflexivity, you know, when I could. That's why I emphasized to Andrew's point, you know, there is a fundamental story here in terms of growth, productivity, and innovation.
Did you argue? Because there's an article today. This is the first time it's ever happened where there's some Fed dissent. Do you think there's more right now than average from what you hear?
I think that historically we have had dissents. During my time at several meetings in 2019, we had 3 dissents, I think, out of 10 votes. And so I think for the most part, that's a healthy part, especially when you're at this point in the cycle.
Yeah. Nobody needs groupthink, rubber stamp.
Absolutely not. And in fact, if anything, a year ago, there were a lot of headlines saying there's too much groupthink at the Fed. They've taken care of that problem now.